In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about how US might soon see 24/7 stock trading happening in its stock market. I then discuss some interesting details about how the RBI and government are fighting against each other for interest rates. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host, Kashish Kapoor. Today is Monday, the 2nd. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments. Let's start with the first story. In an online world, there are few services that aren't available at night. From a tub of ice cream to a microwave oven to movie tickets, you can place your orders no matter what the time is. The idea of specific business hours is on its way out, except when it comes to the stock market. All over the world, stock exchanges are open for a short period of 6 to 8 hours. That's all the time you get to wrap up your investing or trading activity. If you miss that window, you need to wait for the next trading day, but that might soon change. In the US, the SEC has approved a new stock exchange with a peculiar feature, round-the-clock availability. It's called 24 Exchange or 24X. Starting in 2025, 24X will let you trade stocks 23 hours a day, 5 days a week. This is the first time a stock market will officially work around the clock, and it's a massive shift. If this experiment works, you might soon see exchanges all around the world, including India, formulating similar plans. So, what does 24-hour trading mean for you as an investor or a trader? Let's talk about how this could change the way you trade, invest, and engage with the market. To understand how big a change this is, let's rewind a bit and see why stock trading works in the way it does. Back in the 1600s, trading wasn't something you could do from your couch. Early stock exchanges like those in Amsterdam or London were just physical places for traders to meet and exchange stocks. These didn't even start as regular places of business. The London Stock Exchange, for example, began in a coffee shop. Naturally, everything was physical. No apps, no screens, just people shouting prices across the tables. Because of this, trading hours were limited. You could only trade when everyone was physically there. The legacy of these early days is baked into how the markets work right now. Even as stock markets modernized and exchanges like the New York Stock Exchange came into being, this idea of set hours stuck around. And that's still the case today. Most markets operate between 9:30 a.m. to 4 p.m. local time. Anything beyond that, like after hours trading, is more of a recent workaround. But here's the thing. Today's markets are powered by technology. Trades happen electronically, often in milliseconds, and yet we are still following a schedule designed for a world where everything had to happen in person. A 24-hour exchange merely brings business practice in line with what technology already allows. Now, after-hours trading isn't exactly new. There's already proven demand for such a service. Platforms like Robinhood and Interactive Brokers already let you trade before or after the market officially closes. They do this through a method called Electronic Communication Networks or ECNs. It's not the same as official stock market, but it gets the job done. That said, not having an actual exchange in the background comes with its own challenges. There are various restrictions on the securities you can trade in and the types of orders you can place. Liquidity is often thin, meaning there aren't enough buyers and sellers. Trades don't flow as smoothly as during regular hours. Prices can jump around unpredictably, and getting a fair deal can be tricky. A true 24-hour stock exchange could fix that. For one, it creates tremendous convenience. Global investors, for instance, would now find it much easier to access US stocks. Imagine you're in Asia or Europe and you want to trade US stocks during the day. Right now, you'd have to wait until the US markets open or trade during after-hour session with limited options. But with a 24-hour exchange, you could trade in real time, reacting instantly to news and events. It's not just about convenience for global investors though. Let's say there's a big company earnings announcement after regular market hours. Today, most traders have to wait until the next morning to react. With a 24-hour trading window, they won't have to wait. They could act immediately. If this all sounds familiar, it's because we've seen it before. Cryptocurrencies already trade 24/7. You can buy cryptos like Bitcoin or Ethereum at any hour of the day and markets never close. Currency markets also work similarly. Equities are just playing catch up. But does this convenience bring its own challenges? There are two questions we need to ask. What happens to liquidity and volatility? These two factors are critical because they shape how smoothly the market operates and how risky it feels to trade. Let's break it down. First, liquidity. Liquidity is a fancy way of saying, can I buy or sell something without messing up the price? The more the buyers and sellers you have, the easier it is to trade without affecting the stock's value. Now, there are two possibilities here. First, people might take to trading more as markets stay open longer, while more people across different time zones would be able to participate. Alternatively, people's trading activity could be stretched across 23 hours, spreading it thin. Liquidity wouldn't evenly be distributed. Certain periods like middle of the night in the US might still see very little activity because the majority of traders are asleep. In reality, you'll probably see a mix of both. While overall liquidity might improve, some hours would remain thin, making it harder to execute large trades without causing price swings. This might have a domino effect on volatility. Volatility is all about how much the prices fluctuate. A 24-hour market has the potential to smooth out volatility because investors can react to news as it happens rather than waiting for markets to reopen. For example, if a major event occurs in the night, traders can act immediately instead of piling into the market when it opens. Instead of a sudden price gap when the market opens the next day, you might see prices evolve smoothly through the night. But, and this is a big but, volatility could also spike during those quiet hours when liquidity is low. Imagine a single large trade happening when there aren't many buyers or sellers. The trade could push the prices up or down significantly, creating wild swings that won't normally occur during busier hours. And let's not forget the human factor. In a market that's always open, the absence of cooling off periods could lead to more impulsive or speculative trading. Think about it. You see, investors must compulsorily cool off after the closing hours of a market day. These act as natural pauses. They give everyone, from retail investors to institutional traders, time to step back, process the day's developments, and think about their strategy. Without a pause, we could find ourselves in a situation where emotions dominate trading decisions even more than they currently do. Even today, a lot of market activity is driven by either fear or greed. These send people into spirals, creating exaggerated movement in stock prices. If people don't have the ability to snap out of it after market hours, it could send prices to extremes, creating rapid upswings or crashes that might not reflect the actual value of that asset. Either way, it's worth paying attention to what happens. If this model works in the US, it could set a precedent for markets around the world. Even if India doesn't go fully 24/7, this could spark changes like extended trading hours or new ways to make markets more accessible. For now, all we can do is watch how this unfolds in the US because who knows, someday you might be trading Indian stocks at midnight as well. Now on to the next story. Imagine you're planning to buy your first car or start a small business. Only things simply won't fall into place. No matter who you ask, you're simply unable to find financing at a rate where such a big investment would make sense. The interest you'll have to pay is far higher than any returns you'll get on your own investment. And so you keep pushing your investment for later. That's exactly what's happening across the country right now. And that's shaping India's economic trajectory. After many quarters of robust growth, India is seeing a sharp slowdown in its economy. This is perhaps why key ministers in the government, including Finance Minister Nirmala Sitharaman and Commerce Minister Mr. Piyush Goyal, have recently begun making various public statements, all around one theme. The Reserve Bank of India, RBI, should lower interest rates to make borrowing cheaper. But there's no indication that RBI is listening. Although RBI will be debating this question soon enough at its policy meeting on December 6th, many economists expect the RBI to keep rates exactly where they are, at least until February next year. Governor Shaktikanta Das have taken a hawkish stance on inflation for a long time, and there's no indication so far that he'll relent. But what is this standoff between the RBI and the government all about, and what importance does it hold for our economy? Let's first look at this from the government's perspective. India's economy grew at a robust pace last year of over 8%, an anomaly in today's subdued global economy. But things have slowed down considerably since then. On Friday evening, for instance, we got some shocking news on the economy. In the September quarter this year, India's GDP growth has nosedived to mere 5.4%, the slowest in 7 quarters. This slowdown was already evident in people's everyday spending. Private consumption, which makes up about 60% of the economy, has taken a big hit in recent months. Major FMCG companies like Hindustan Unilever or Colgate Palmolive have reported weaker sales, showing just how tight household budgets have become. Sales of everything from cars to biscuits have fallen. The government thinks our economy needs a boost. This is why key ministers have been making the case that cutting interest rate could help fix the problem. It's not hard to see why. Whenever someone takes a loan, the money they borrow goes into the economy. When they invest or spend their borrowings, all the money becomes someone else's income. So every time someone looks at the high interest rate and avoid taking a loan, that's money that is being held away from the economy. Moreover, lower interest rates could create greater savings for borrowers. For example, imagine a mid-sized company takes a 10 crore loan to build a new factory. At an interest rate of 10%, they would pay 1 crore every year just in interest. But what if interest rate came down to 7%? Their annual interest cost would drop to 70 lakhs, saving them 30 lakhs. That money could be used to hire more workers or improve their operations, thus going back into the economy. All this extra money might just boost India's economy needs. But here's the catch. The RBI sees this situation very differently. You see, while extra money can boost economic growth, it can also cause inflation. Back in 2021, interest rates were much lower than they are today. The RBI had cut rates at the start of the COVID-19 pandemic to give our economy precisely the sort of boost that government's currently talking about. But that had unintended impact. As money entered our economy faster than things to sell, inflation started shooting up to unsustainable levels. Now the RBI's main job is to fight inflation. And as inflation rose, it got to work. Throughout 2022, it steadily raised interest rates, making it harder for people to get their hands on money. The repo rate, which decides the cost of borrowing, went up to 6.5%, the highest it has been in years. It has refused to bring them down ever since. This was a success, albeit a limited one. After many months of rates being higher than normal, inflation was back to RBI's tolerance band of 2 to 6% for large parts of the last year. But it isn't quite under control yet. Food prices have been high for months, and in October, overall retail inflation shot higher than 6% once again. Lowering interest rates now could make things worse. If loans become cheaper, more people might borrow and spend, and all this extra demand could drive prices up further. That would hurt the same households the government wants to help. So, who's correct? That isn't an easy question to answer. There are many theoretical questions at play. A specific point of disagreement, for instance, is whether monetary policy works against the food inflation. Either side could be right. Unfortunately, if we make the wrong decision today, we won't know it immediately. Monetary policy works with a big lag. Somewhere late in 2025 though, we might have an episode where inflation goes through the roof or one where growth suddenly stagnates. Only then will we know whether we got the things right today. Now, tussles between governments and central banks are quite common. In the United States, for instance, Donald Trump threatened to fire US Fed Chair Jerome Powell for refusing to bring rates down back in 2018. In 2021, Turkey President Erdogan fired 3 central bank policymakers for opposing rate cuts. This is only natural because elected governments have to answer to the public. They are driven towards decisions that have short-term impact. That's precisely what happens when money rushes into the economy. It instantly drives visible improvements in people's life as economy becomes buoyant, business profits rise, and jobs are created. Rate cuts are just naturally attractive to elected governments. This is why it's a job of central banker to act as an adult in the room. It's the RBI's job to be cautious and think about long-term, balancing against the government's need for instant results. In fact, the RBI is built to take unpopular decisions. One of the signature reforms of the Modi government was to overhaul how the RBI worked back in 2016. Through those reforms, controlling inflation became the main duty of the RBI, and its governance structure was set up in a way where even the finance minister can't force it to do anything else. So when you think about a tussle between the government and the RBI, it's important to keep one thing in mind. This is exactly how things are meant to work. Now on to the tidbits. First, Mahindra's new EV models BE6E and XEV9E promise fast charging and better performance than the lackluster XUV400, but face hurdles due to India's inadequate EV infrastructure. With EVs making up just 10% of M&M's capacity, investor doubt and weak demand signal challenges ahead in scaling adoption. Number 2, the Airport Authority of India is modernizing 150 small airports to boost air cargo capacity for pharmaceuticals, perishables, and agri-goods. With domestic cargo projected to grow at 7 to 9% and international cargo by 11 to 13%, this initiative could solidify India's position in global logistics. Number 3, mid-cap IT firms like LTI Mindtree, Coforge, and Sonata Software aim for aggressive revenue milestones. But investor sentiment remains cautious due to macro uncertainties and reliance on AI strategies. Execution and short-term clarity will determine the viability of these bold ambitions. Next, the CCI is investigating Google for alleged unfair practices following complaints from Winzo Games over its exclusion from the Play Store. The probe could lead to fines or policy changes reshaping India's gaming and app ecosystem. And finally, India's top steelmakers face rising debt as they expand capacity by 30 MTPA by FY27, pushing leverage to a 5-year high. While profitability is under pressure, strong liquidity and long-term growth plans indicate manageable financial health. That's it for today. This was the Daily Brief. I'm your host Kashish, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.